Good afternoon, traders. Scott G here with the Simple Trading Life. This is our Tuesday edition of our YouTube live stream. So glad you could join us. And we will be going over a few things here today and hopefully help everybody become better traders and more profitable. If you have any comments or questions, just type them into the chat right here where I am saying hello to everyone. I have it right here so I can see it right next to me. And we're kind of going to go over a few things related to the market, how we're able to look for high probability moves that can lead to nice profits. ES has definitely given just yesterday, going back to Sunday night, which was the start of the week, through today, has given several very nice moves that would have been very profitable if you were patient. And we'll talk a little bit about that as well. So I went on just a couple of minutes early. We'll wait here till just a little bit after 2 to get started. I have ES up on my screen here. You can see prices faded back to the 20 simple moving average on the 30-minute chart. It actually poked below and right now is holding right there. So we're going to see if it's able to hold or bounce, or is it going to push through and try to go lower. So we'll look at some things here in just a minute. Maybe be able to tell what the probabilities are of where it might go. So it's just now turning 2 o'clock. I see several new people joining us, so welcome everyone. We're just giving everybody a couple of minutes to join us, and then we're going to get started first of all by analyzing the S&P 500 E-minis. And then we'll probably look at a few other things. But as I was just saying, because I know several people just joined us, ES has given us quite a bit since Sunday night. So we're going to go back and kind of look at that. I'm going to show you a few ways of being able to tell or have a good idea of where price might be going and how to take those trades. So we got a quick little pop there, just as we've been talking. Again, just giving everybody a couple of minutes to join. Okay, a little pop right here off the 20. So we've got some different scenarios we can look at before we go back to Sunday night. Okay, we could J-hook right here off the 20 and go higher. Maybe up into here, and then if we break through here, you can see I have an alert set right here above this wick. If we break that wick, we're looking at getting up into this zone right up here. And where is that zone from? I can show you. Scroll back over. It's this basing area right here. Okay, so that would be another likely area to see some resistance. So we'll go back over to current price. Again, while we wait and see if we can get a few more people to join. If this is your first time, welcome. Please give us a thumbs up. That really helps us out with YouTube, and subscribe to the channel and turn on that notifications bell so you'll know anytime that we go live and you can join us. So here's what I'm going to do. I'm going to set an alert because I want to go back to Sunday night and kind of show you some of these trades that you could have been looking for. So we're going to set this one there. And then if it starts to go lower, we're going to have an alert down here as well. And we can always pop right back over to current price. Okay, there we go. So if price breaks above here or below here, we'll get alerted. Yes, there's several more people, so welcome. All right, so let's go back to, let me see here, there's Friday, and let me do it this way. This will be easier. So it would have been right up here. Just trying to make sure. It's Monday. And right here. Okay, so here's Sunday. And I have it marked on our chart. See this gray box? So Sunday night when we opened, one of the things that I've been trying to point out to the Simple Trading Life community, and that's at simpletradinglife.com, you can join our free chat room, is looking for trades off of the opening range. Now this is a 30-minute chart. So you have to show patience, especially if it's the overnight session. Now here, what do we mean by opening range? Let's start there. Most people who trade opening range either trade a 15 or 30-minute chart. Now I love the 30-minute chart. Okay, as you can see, that's what we're on right up here. So opening range for us is this first 30-minute candle. Some people like the 15-minute candle. Nothing wrong with that. A lot of times the range is going to be very similar. It might even be exactly the same. But sometimes that first 15-minute candle, it might have a little bit smaller range, and it may cause you to get stopped out a little bit more often. I mean, and there may be instances where you get a few extra dollars because of it. But I like the 30-minute. I think it's much more consistent. So what is that range? Is the high and the low of that opening candle. So that's what this gray box is. Okay, so an opening range trade is when price breaks out above or below the opening range. Okay, we're not talking about just barely poking out, actually getting outside of it, a dollar, 4, 5, 6 ticks. And you can see when it does happen, look at the strength of the move. Now, where's it going? You have to have targets. Oh, just had a bunch more people join. Welcome, everybody. So you have to have targets. So our target Sunday night to the downside was this zone right here. And where did that zone come from? Let me see if we can get back over to it. Let's see. Let me get back over here. I apologize. Let me see if I can do it this way. I might have to go to a different time frame, actually. Yep, to be able to see it. There we go. All right. So our target was based off of a zone that was created right here. Okay, now it was on a different time frame, but if we go back to the 30-minute, I want to show you this again, and then go back. I gotta find Sunday. Which was right here. Okay, we go back right to there. We have this zone down here. Now, why is that important? You need to have targets, right? The upside zone would have been up here. Okay, it would have been right here, right across there, if it would have broke to the upside. It broke to the downside. The bottom of this zone was 29.80.75. So you probably would have entered around 29.80, approximately. Let's just use that for easy math. It got as low as 29.35. Now, I would have exited before then. I would have exited right at the top of this zone. Why? Because you may get to this zone, right? It's going to be a level of demand, and you might see a quick bounce away. Now, what happened here is we actually came down into the zone, a couple candles, then we bounced away. But you can see the zone held. So for me, the trade would have been from about 29.80 down to about 29.47. So that is what, about 33 points. Okay, and that would have been a highly probable trade. It actually went all the way down to 29.35. Okay, so could you have just waited and tried to let it get all the way down in here and then when it started to bounce? Sure, you could have, right? As long as you're watching that, but this was happening at 1:30, 2 o'clock in the morning. I don't know how many people were still up and trading at that time. I wasn't, right? I wasn't, but if you're somebody who likes to trade the night sessions, you can do that. You can also place set and forget trades. What do we mean by that? You can have a trigger to enter the trade. You can set all this up ahead of time. You could have your stop, up in the middle of the zone somewhere, and it could be set either way, where it'll trigger, and then you'll have a target, and wherever your target is, if it hits the target, it'll get you out of the trade, collect your profit, or if it goes back against you, it's going to hit your stop, and you'll take your small loss, and you'll be out of the trade. But that was 33 points to just before this zone. It actually went into the zone before it bounced. Okay, a trade could have been taken out of the zone. Now, where would your target have been? Your target would have been somewhere right up in through here. Okay, what happens a lot on these opening range breakout trades is once price gets to a target or a zone, it will then reverse and go back and retest where it came from. That's exactly what it did. You could have took 33 points the other direction, right? So you could have had it here and you could have had it here and it would have been highly probable. Again, it went past that. It went past that. Okay, then it put a little level of structure in and then it moved up again. Now, let's go back over here. Okay, let's find it. Okay, here was the opening range the next morning. I've already taken the box off, but just let me draw it in for you so you can see it. I want to show you how highly probable these trades are. Okay, so let's just do it like that. Okay, so the next morning, there's your 9:30 candle. There's your opening range. It broke out, came back to retest, and then it just took off. Okay, ended up going clear up here. I've already taken the zone off, which would have been right through here. Let me put it in so you can see it, and then I can always take it back off again. So your zone would have been about right through here. You could even come up to the top of this wick, right? So there's your zone, and you can see not only did it get up to it, it kind of paused, and then it broke higher. Okay, so here was your trade. Your trade was, you could have entered here, you would have had your stop somewhere in the middle of here. If you want to be really tight, you can put it just under here. You would have been close to getting stopped out, but you can always re-enter if it goes back your way, right? When you're trading futures, there is no PDT rule. You can trade you can trade 50 times in a day if you want. That's the beauty of trading futures, right? So even if you had a tight stop and you got stopped out, you could have re-entered when it went back your way again. If your stop was somewhere down here in the middle, okay, you wouldn't have got stopped out. Some people put their stop all the way at the other side of the range. I don't like to do that because I think that's way too big of a risk. This is just me. If you're wrong, you're not taking a small loss, you're taking a pretty big loss. So I like to have a much tighter stop, and then I like to re-enter if it goes back my way. Okay, but again, from the top of this zone, which was 29.98, so you would have probably entered around 29.99, okay, up to this zone, which the bottom of it was about 30.47. So let's just say you would have exited it at 46. 99 to 46 is a 47-point move from here to here. Here to here. And that was highly likely. And then it paused in here. It paused, and then it went higher again. right? It went higher again. Let's come back over here and see. Okay, right here would have been like your next, if I draw it in, okay, there would have been your next zone, and look where it went, right into it, and then it bounced, came back down to the top of this zone. Now, once a zone's been tested, unless it just like literally barely touched it and went away, I'll sometimes leave it because you might get a second bounce. But when you get up in through here like this and go on through, then you can take this out. But then see, this next pop went to the next zone. That's where we should have caught resistance, and we did. Bounced all the way back down to this area, bounced up again, and then we got over into here. Okay, so let me remove this. I'm just putting these back on here so you can see I remove them once they're no longer valid. All right, so now we're starting the next overnight session, and here was your opening range on the next overnight session. Did it work? Absolutely did. Okay, look, here was our breakout, then we based, then we went higher. Okay, let's look. Let me take this back off. Okay, let's go back and look. Did we have an area up around, what's that, 3120? Okay, let's come back over here. Let's find the 31. Okay, let me see where that high was. Okay, so that would have been right up in this area. I don't know that this would have been a common area. I would have been looking more up around here. Okay, here's where I would have been looking. Draw it in. Now let's go back over. Okay, there it was. All right, so we did not get all the way up to that next zone, but from the top of, let's see, we are now going up on ES. That was my alert going off. We went from 3086, or say 3087, and this got as high as 3124.50. So let's just say 3123. So what's 87 to 23? That'd be 13 plus 23 be 36. So right here was a 36-point move. Then it kind of based. Tried to come up again. Okay, sort of double topped. Then it dropped. Right? Where did it drop to? I've already taken it back out. Okay, look at this. I hope you guys start seeing these levels. Okay, because it's always highly probable where price is going to go. So it came, it never made it all the way up here this time, right? This time, it kind of based, tried to come up, it couldn't do it, and then where did it drop? Right back into this level that was created. See this basing area here? Rally, base, rally. Okay, and what did price do? It came into here, and then it came out again, and this time, it did get all the way back up into here and even higher. And even higher. All right, so let me take this back off. Okay, I just want to make sure everybody sees that. That's where price came to. That was predictable. Then it bounced. A little bit of basing right there, and then we got a big pop. Almost got up here to this level, which is 3172.75 is the start of a zone that's a little bit higher. Okay, almost got up there. Sellers came in and pushed it back down. Now we're to today. So let me get this one removed, because once it's been tested, right, for me, that's no longer valid. I remove it. Now, here's our opening range today, this first candle. So what do? We're waiting for a strong break one way or the other. What did we get? Boom, huge flush. It came all the way down into this zone. Okay, where was that zone from? Right here, rally, base, rally. Okay, rally, base, rally. So we had a zone there. So it was highly probable we would see a bounce. So your trade here was just below this zone. This zone, let me see the bottom, 31.3475. So let's just say 31.34. I would have been looking to exit right above here. So let's say 30.85, about $1 before the top of this zone. Now it did go much further in, but you don't know that in real time. You don't know if it's barely going to touch the top of this. Plus you had the 200 right there. You don't know that it's going to barely touch the top of that and really bounce away. Now it went down in, penetrated, and then it got the big bounce. So you just don't want that big bounce to go against you. So 30.85 minus, what did we say up here? 31.34. So let's see, 34, and then 85.15. So what is that? That's a 50-point move from just outside of here to just outside of here. 50 points. That's this morning. Then you could have took the bounce, right? Once it came all the way down in through here, came back and took out the level. This is opening price on this candle. Once it went all the way down here, came back through and started going green, you could have took that. Now it's aggressive, right? And where would you have been looking? Well, right here, right? Right there. Because this drop means this is a supply zone. And where did price go? Right back to it. Right to it. And then it pushed away. So from here, let's see, opening price was 3091. So let's just say you got in at 3092. Back up here to, you would have exited about $1 before. So let's say 3133, just to make the math easy. That's actually $1.50 before. So 92 to 33, that's 41 more points. You could have caught 50 here, okay, from just under here to down here, opening range breakout. Then you could have took the bounce out of the demand zone. Once it took out opening price on this candle and went green, and you would have expected it to at least make it to the bottom right here, okay, because that's a supply zone, and it did. It went right to the bottom, bounced, came back in, and it keeps butting its head up against there. Now, eventually, it probably will eat through here, all right? It will probably eat through there. Okay, so infamous, the blue lines are what I'm using for supply and demand, and I'm doing it for a reason. I changed from the green and the pink because the blue, it stands out a little bit and it gives you these prices. See the blue prices here and here? It tells you the price levels of the zone. So when I'm watching like a drop here, I know that I'd want to exit slightly before that, and it gives me that price number without even having to look at it. Like I have to hover over, okay, and you see it brings up that information box when I draw in a rectangle, but when I put it in like this, it actually gives me the numbers. So as price is coming towards it, I know I want to get out about 30.85. So that the black are still the support and resistance levels. So hopefully that that makes sense to you. I've just started doing my supply and demand zones with the blue lines. Instead of green zone and pink zone, they're just all blue. And obviously if you're below a zone, it's supply, and if you're above it, it's demand. Okay? Okay, quantability. Are there considerations you're making with the RSI in comparison to where price is in the zone since it is on the chart? Absolutely. So that was one of the other things we're going to cover today. I've been working with this and testing this on and off for a couple of months now, several months. Those in my premium room know that I was using it for a while. A friend of mine who's a professional futures trader, he uses it. He's actually used it for years, like 9 or 10 years or more. Now, not as a traditional indicator. Okay, so that's what I want to cover. And look at this bounce we're getting out of this zone right now. Look at this. Okay, we're going to cover the RSI down here. Okay, so it's trying to push lower right now. If it takes this out, okay, then we're starting to look, can it take this wick out? And if it can take that wick out, then you're looking at the bottom of this candle or getting back into this zone down here again. All right, infamous. Okay, good. You understand the blue lines now. Okay, so back to Quantability's question. So you see the RSI down here. I am not using it as a overbought and oversold. In fact, I'm using it almost exactly the opposite. I'm using it to determine likely momentum. Likely momentum. So I'm not using the RSI as it's designed. I'm using it differently. So let me give you an example right here this morning. Look at this candle. Okay, look where we're at. All right, but then here is opening price, and what were we doing? Right, what were we doing as price opened? Let me come back over here. I'll be able to draw this for you. Okay, momentum was starting to shift down. Okay, that's well before this candle. All right, you see that? That's well before this candle. In fact, look at this candle here, right? We were still moving down even though this was a green candle. I'm using it to show changes in momentum or validation of momentum. I can probably show you periods of that too. So I'm still looking for it to break one way or the other, but the likelihood and the strength of the move is increased when you see something like this. All right, before this move ever happened, we were losing momentum on the RSI. Again, it's not how the RSI is designed to be used, and this is not unique to me. I got this from a professional futures trader who's been using it for 9-10 years, something like that. Does not use it as buy and sell signals. He uses it as another factor in whether or not he's going to take a trade. All right, so momentum was already losing or declining, and when we broke out of here, then that increases the probability that you're going to drop, right? That you're going to drop, and that's exactly what happened. Now, come back over here. Okay, look at this. Let me get to where you guys can see it better. There we go. All right, look at this huge move that happened. All right, look at the RSI. And I want you to look how long it was up in what traditionally they would consider overbought conditions. Look at that. From here, now he uses it, and I use the same settings that he does. He uses 60-40 instead of 70-30. And it's because he's not using it as an oversold, overbought. He's using it to predict changes in momentum or to physically see changes in momentum or to know if momentum is strong. So from here, okay, look at this. From here all the way up to over here, look at the momentum. And look, traditionally, let me find 70, right around here. So according to the traditional RSI, they should have been looking for sells starting right in here because it was above 70. Look how long it was overbought according to traditional rules. A long time, right? Like 8 hours or more, okay, in what they would consider overbought conditions. I'm not using it for that, right? I'm using it for momentum, and it was right. Look at this. Look at this strong move. All you got to do is look down here. The momentum was going up, right? Then when the momentum changes, see the momentum change? Then you start looking for a downside move. What did we get? A downside move because momentum stopped. The momentum stopped and it started to go the other way. So if you come back over here, because this is all you would have been able to see in real time, okay, you see this. Okay, now it's starting to come down. Now it's starting to change. You're losing momentum. So what happens next? Red candle. Momentum starting to drop even more. Okay? Red candle. Red candle. Okay? See that? So it was predicting there was a change in momentum right there. Now, I would have needed to also see some sort of setup or trigger, but just by looking at this, I would have known momentum was changing. All right? Okay, let's come over here. Why did I say over here, okay, that I kind of felt like it was a better play to the downside? Because look at momentum. Momentum was declining, right? It was declining. So even though we were in this range here, within the opening range, and we were really ranging, to me, the more likely play was to the downside, based on this. Okay, so when we broke out, then look what happened. If you come down here, right, even this first candle here, we weren't getting the big drop, but then we did. Look at this. Then it really started to crater down. And where were we likely to go? You see I'm combining these things together. Well, we had a demand zone down here. We were likely to go to the demand zone. So your target would have been just above here. It went right into the demand zone, and then it bounced. Well, look at this. It cratered, and then it started, and this is that big climb to the upside. All right, so we're combining. I always talk about it, right? Put the probabilities in your favor. This is part of trading price action. Now, I want to combine that with setups and triggers, candle patterns that I like. Okay, your candle patterns may be different, or breakouts of ranges. You guys know this. I'm big on ranges. Okay, expanding ranges, contracting ranges, or sideways ranges. You know, here's a sideways range. Okay, why do I like ranges? Because I'm looking for breakouts, or I'm looking for price to move through the range, like with an expanding range. Okay, that brings me to another point. Let's go look at the 4-hour. Okay, somebody may have been asking like why I've had this expanding range on my chart for so long. Because here we were going to the top of the range, to the bottom of the range, to the top of the range, to the bottom of the range, to the top of the range, and then we never came back through. And then for about 2.5 weeks, we were in this upward channel, actually close to 3 weeks. Then we broke through. Why did I keep this expanding range on my chart? Well, let's look. Once it finally broke this trend line, where did price go? You guys have seen it, right? Especially those in my room. I've had these lines on there going all the way back to here, which that was May 25th. And what's today? June 16th. So 16-3, so there's 3 weeks of trading, and then so about a little over 4 weeks of trading, I've had these lines for this expanding range on my chart. Why? Because until something changes, you're still in that expanding range, and look what happened. Right to it. I mean right to it. And I always tell you guys that these lines are not magical. Right? They're not magical. Here we dipped below it. Here we kind of got above it and we're bouncing, but then we drop back into the range. All it is a guideline. In this particular case, it happened to come all the way back through the range, right? Right to it. Now what are we doing? Now we're going back through the range the other direction. Your expanding range is valid until it's broken and price leaves it. Like up here, we broke above, but price didn't leave. It just kind of bounced along the top, and then it dropped right back into the range and came all the way through, bounced. Now it's moving back through the range to the upside. Does not mean it'll go all the way back through on this attempt, right? Because look here. We came down after we had went up, down, up, down, up, started down, but then we got into this channel. We were in this channel 2.5, 3 weeks. Then we dropped and came all the way back through the range. Okay, and what are we talking about with an expanding range? Price is always trying to discover, right? It's trying to push its boundaries. That's what an expanding range is. All we had to do is clear this by one tick right here, and we were technically expanding the range. We went lower than that, obviously, right to the bottom of the lines I have drawn. But again, there's nothing magical about those lines. We bounced right off of it. Now we're moving back through. Now we could get up in here, turn around, reverse, and come back down, test it again. Or we could get up in here. Okay, let me show you. We can get up here, and we could chop around for a while and then go higher. There's all different kinds of things that can happen. But right now, doesn't it look like we're moving back through the range? Just like here, once we broke this, we quickly moved through the range. All this was structure. Okay, I remember when this happened, everybody was like, oh, you know, bears got excited, but the bulls are back in control. Really? All this was a level of structure. Okay, lower low, lower high, lower low. Then we bounced. So I hope that really makes sense and sheds some light to everyone, because obviously, okay, this stuff works. This stuff is, when I say it's valid until price leaves, if we would break one side or the other of the expanding range, I'll tell you what typically happens. You'll break, you'll retest it, and then you'll move away. You'll, like, literally, you know, maybe you move away several hundred points or something, or up to the top side, same thing. You'll break it, you'll retest it, and then it'll move away. You know, 200, 300 points, whatever. Then that range is no longer valid. That is no longer an expanding range at that point. Price has then pushed through and is going to start some new range. You can also have contracting ranges within an expanding range. So just for a shorter period of time, you could have a contracting range. These are all the kind of things that you need to develop to be a consistently profitable trader. It also helps you with magnitude of move. Okay, I don't do much swing trading. I'm going to concentrate more on, I say this and I almost always revert back to scalping, because I've always been a scalper and I'm pretty good at scalping. That's my comfort zone. But I'm trying to be more patient with day trades that may take a few hours. Okay, still a day trade, right? Because they're highly probable. Let's go back again. Let's go back to the 30-minute. They're definitely easier from a mental standpoint when you can take these trades. Now that one happened pretty quick, right? This one here happened within, you know, say 30 minutes, a 50-point move. Okay, so that's still scalp, right? Most day trades, I'm talking about like an hour to several hours. But from here, okay, coming back up to here, that would have been 2 hours, right? That would have been 2 hours. That's more of a day trade. But they're probable. They're highly probable, and you could do set and forget. And I've been really busy like the past few days. I've got a lot of non-trading stuff going on business-wise. So like yesterday, I was literally on the phone for almost 6 hours yesterday. I wasn't able to do our private live stream in the Simple Trading Life community because I was literally from about 11:45 in the morning until it was like after 5 something till about, say, 5:30. I was literally on the phone almost that entire time, 4 different phone calls. Now, can I scalp during that? No way, right? Because I'd be distracted. But could I take set and forget day trades? Absolutely. Same thing at night. People that like to trade at night but obviously don't want to stay up all night, they can do set and forget trades, right? So let's go back, right? Here was last night, opening range, okay? Look down here. Where were we likely to go? Okay, let's talk about probabilities. Well, look down here. Again, we're using the RSI as a momentum indicator, not overbought or oversold. Let's just get that out. I personally have never liked RSI for overbought or oversold because, again, it'll stay overbought or oversold for long periods of time. In fact, I'm going to digress for a second. I was watching a video that somebody did that does a lot of back testing. That's what this guy does. He takes different strategies and he does back tests, and he does at least 100 tests by rule. Okay, so he does it exactly by rule how it's supposed to be done, and then he comes up with his conclusions. He took RSI 70-30, and he followed the rules exactly about how you should use RSI and traded it, and it only worked 49% of the time. And on 100 trades, he was using a $10,000 simulated account. It only made like right around $1,000 on 100 trades. So what's that, like 10 bucks a trade, right? We're not in this to make $10 a trade over 100 trades. Vice versa, and I don't use this. In fact, I've never used MACD. I've never used it. But strictly by the rules of how you're supposed to use MACD, he did a test on it, and just using the rules. No trade management, no modifications. And what I mean by trade management, like he wasn't moving his stops up into profitability, or anything like that. He was just trading it the way it's taught in the books. MACD worked 62% of the time on 100 trades. And it made, on a $10,000 simulated account, it made $5,000 on 100 trades. So, again, that's not spectacular, but that was without managing the trades or anything. Imagine if you were managing the trades. But I don't use it. I've never used MACD, ever. But that's just giving you a comparison where if you're using RSI as it's designed, didn't really work that great. Okay, and then there's squeeze indicators, and there's all different kinds of other stuff. I'm not a huge indicator guy, but again, because a friend of mine who is a professional and a longtime professional, and he's a worldwide instructor, he's used this as a momentum, a way to determine if momentum is strong or if it's fading or if it's changing. I've started to play around with it, and it does tend to work a lot. Okay, you're not trading off of it, it's helping you. So let's go back over here again. This was last night. So what, based on this, right, we were more likely to break to the upside, and then you would have had whatever your targets were. You could have had a super conservative target. Maybe it was the 200, all right? Even if that was your target, let me look here. 85 to 98, that still would have got you 14 points just to here. Okay, you could have done a set and forget trade and set it, about $1 outside of here and maybe about $1 underneath the 200, and you get $14 on a set and forget trade, and we were more likely to go up based on this, right? Because the momentum was going up. It wasn't until we broke below here, and that would have been in this area, okay, see this, that momentum started to change. Let me see if I can, yeah, there we go. Okay, momentum started to change right in here, and it was right through here. Then you would have started looking for some downside. All right. Okay, let me get that. Okay, here's a question. Others I'm sure have too. When creating trend range lines, do you use the end of the wick of the candles to create the line points, or the open and close of the candles? Okay, so that's a great question. You may or may not like my answer. I really don't think it matters. And I know a lot of people that they only use the wicks. Okay, so I'm just going to make this up. Somebody thinks this is a trend. right? And they're going to only use the wicks. I'm just, I'm just making this up right now, right on the fly. Okay? Other people are only going to use the bodies. Let me do it like, well, actually, they would have done it like that. All right? Now, I want you to look that basically they tell the same story. Right? Even, from here, body to body to body, body. Then they would have started saying right here, oh, we better be looking. We're breaking below. Okay, we retested. Oh, we're back above. Now we're going sideways. Okay, so on and so forth. And if you would have went wick to wick to wick, it's basically the same story. It really is. So I don't think it matters. I watched something not too long ago, and I liked what the guy said. Somebody was asking this particular teacher, guru, whatever. They said, when you're doing a trend line, do you do the wicks or do you do the bodies? He said, yes. And then he was like, I'm just joking with you. He goes, I do whatever I feel gives me the most touch points. So let's just say, I'm trying to find something here. Now this one's even a little bit lower, but see how we have this big wick here and everything else has small wicks? He would ignore that. He would say that's an anomaly. I'm just making something up here. And then he would kind of draw this, kind of across here, touch point, touch point, touch point, touch point, and he would ignore that. He would say that's the anomaly. He's looking for as many touch points, and if that's the bottom of the bodies, or the top of the bodies if it's on top, or if it's the bottom of wicks, he doesn't care. He's just looking for the most touch points. But I really do not think, in my personal opinion, that it matters. Just like the example I gave you over here. Doing it at the bottom of the bodies or doing it at the bottom of the wicks, it tells the same exact story. Okay, quantability. Yep, I see your answer there. So, but I think that touch points, right? That's a good answer. But whatever you want to do, right? Whatever you like, because you're not going to basically trade that, or at least you shouldn't. If you see a break, you're still looking for other reasons why you should be in the trade. There should be either a candle pattern or a bunch of different factors. Okay, I know we're losing momentum, or I know that we're in this range and we're breaking out of the range. Plus, we're losing momentum. Whatever. You just start adding everything up together. And if you have enough factors that go your way one way or the other, that's all you can do. You're looking for probabilities. Look how many times we keep getting into this zone. It's so funny because this wasn't a supply zone until this candle. Then this actually became a supply zone. Like I could draw my blue lines, but since I have my gray box there already, I'm just leaving it. This became a supply zone because of this candle. Why? We had a drop, base, these two candles, base, big drop. And when something leaves a level like this, that tells you how many sellers are in this zone. And look, 1, 2, 3, 4, 5, 6 times. 6 times it's tested this zone and haven't been able to get through yet. That tells me a couple of things. That tells me how strong this zone is, but it also tells me how aggressive the buyers want to get through here, right? Because what typically happens is if there's no aggression by the buyers, once we get up here a time or two, then we fade away, right? Because they just say, there's just too many sellers there, we can't get through. But right now, look, it's a struggle, okay? We're in a contracting range. I'll draw that in for you. Okay, so it would look something like this. Okay, see that? So we're in a contracting range, but we've also 1, 2, 3, 4, 5, 6 times Buyers have tried to push up into that supply zone and have been met with resistance every single time. So what's going to happen when we keep getting closer and closer down through here? Well, at some point, somebody's going to win and somebody's going to lose. Either eventually, what's really going on is because we haven't dropped away yet, buyers are trying to eat up this supply. They keep going up in there and taking more of those orders. They go up in, they take more. They go up in, they take more. Right? Again, if they were weak, price would have already bounced away. We would have already been coming this direction. So again, we're putting all this together. We're in a contracting range, which means price is tightening, energy is building. We're also above the 20. You see this? The 20 had crossed over the 200 here. Okay? It's starting to widen from the 200. The 200, if price continues up, will start to flatten out. Okay, right now it's got this little diagonal downside move, but if price continues up, it'll start to flatten out. And if it gets through here, we know right up here is another zone. Okay, so we know where price is likely to go. It's likely to at least get up in there if it can break through here. So there's a bunch of stuff going on, right? So you should, I say this all the time, I'm just drawing this in for your benefit, but once you start to get really good with price action, you'll just see this with your eye. You'll like draw this triangle with your eye. Okay, all right, I see what's going on here. Price is contracting. Okay, energy is building. Bulls are strong and bears are strong. That's why there's a struggle here. Both of them are strong right now. Eventually, one of them is going to win. And when that happens, okay, as a trader, as a scalper or a day trader, or if it's on a bigger time frame, right? These patterns can happen on a daily, a weekly, a monthly. If you're a big swing trader, okay, if it's happening on one of those time frames, you just want to be ready for when that energy releases one direction or the other, and then you want to have your targets. To the downside, it's going to be either here or here. To the upside, it's going to be up around here. It's really that simple. Okay, it's not difficult. And I'm not, when I say that, I'm not like downplaying or trying to like imply that people who are watching this don't get it or whatever. What I'm trying to say is it doesn't need to be complicated. It's this simple. You get all these traders that have all these complex rules and formulas and this and that. It doesn't have to be that complicated. In fact, that usually leads to analysis paralysis, and people, they fail to move when they should, and then they get in late, and then they get out late. Right? So they don't get the best entry because they were paralyzed. They have so much like analysis going on that they get in late. Then price starts to go their way and they think, all right, well, I need it to go more because I got in late, and they wait and then it reverses against them and they either, give back their profit or heaven forbid they go red. That happens to so many people that trade like complex strategies. I know because I used to do it years ago. I had people, you got to do this. The only people who, this is such a lie. When you hear people say this, just get away from them. The only people who truly make money are the ones who understand the math or the ones who understand this or that. I mean, I know so many guys like that. If you don't understand the math of the market, you're never going to succeed. I can tell you right now, I know several traders that trade that way. They're not that good. I know them personally. They're not that good. They spend all their time doing analysis and they spend very little time actually taking profitable trades. And then they'll go back after the fact and they'll adjust their math and they'll say, I was wrong because I didn't have my math quite right here. If my math would have been right, I would have been right. Now, it's not that hard. It's really not. Just trade price action. Look for predictable patterns, right? Know to the best of your ability when momentum is in your favor, when momentum may be starting to wane or even drop. See, the good thing about how my friend uses this down here is because in a lot of cases, it actually tips you off ahead of time, right? Like here is a perfect example, right? It was tipping you off. I already showed this to you. If we were already back over here, okay, momentum was already changing when this candle was still green. It actually started changing over here. From here all the way over to here, momentum was going down. And even though this was a green candle, in your head, you got to be thinking, if we don't break this, I should be looking for a downside move. Oh, we didn't break it. Oh, here we go. Okay, and there it was. There's your downside move. We were tipped off. That's just one thing, but it happens all the time. Okay, over here, same kind of deal. Okay, while price was going sideways, the momentum was actually going down. So if we break out, in your mind, you got to be thinking, okay, we could get a drop here because momentum is fading. Now, vice versa, and I don't want to get everybody all confused. I'll touch this very, very briefly. Very briefly. Okay, right here and right here, okay, were we likely to come up in here and bounce or break through? From a strictly momentum standpoint, we were more likely to break through, and we did. Why? Well, look. Okay, what was momentum doing? Momentum was increasing, and it really started to increase even coming back here. Look at this. It was really starting to turn up. And then what happened? We got this big pop right up through this zone. So was there a way to know that that was possible? Yes. Okay, that's something that my friend believes in and teaches. Is the reason he uses 60 and 40 is when you're coming to a supply zone or you're coming to a demand zone, he'll look at this, and if you're trending up and you're above 60, which we were, when you get here, he thinks that it's not a good trade to immediately think that you're just going to get up here, bounce, and start down. He thinks it's actually more likely that you may break through it. And right here's a perfect example. Momentum was up. It had actually started even going steeper, and it was above 60. Okay, right over here, 60. It's this top line. So in his mind, you definitely didn't want to look short right there, and he would have been right? Look at the big pop. Then it faded back down, based, and then dropped. So, see, several new people, welcome. We've really been digging deep into some price action trading, using supply and demand, using the RSI, but not the way it's designed. So if you just joined us a little bit ago, you may be a little bit lost on what we're talking about. But using the RSI down here to gauge momentum, not overbought or oversold. I don't care about that. I don't care about that because it's not right enough of the time. It's not right enough of the time to use it the way it's designed. That sounds crazy, I know. But hopefully, just in what I've shown you here in about like the last hour, you can see using it to gauge momentum is way more accurate than using it for overbought and oversold. Because like we showed you here, it was overbought for like over 8 hours. There's been times, I mean, you guys have all seen this, there's been times that like on a daily chart, it'll be overbought for 8 days, 2 weeks. Okay? And people, back when we had the market correction, February, March, whatever it was there, those in my premium room, they know I was kind of, I never call anybody out by name. I don't do it. I don't think it's right. Unless somebody would ever attack me personally, I don't call people out by name. But there was a famous or infamous guru on Twitter, and when we first started the market correction, all the way down, he kept saying, I'm buying the dip. I'm buying the dip. I'm buying the dip. I'm buying here because we're going to go here. I'm buying here because we're going to go here. And what he was gauging it on is that we were oversold. And he kept going, we're so oversold. Man, this thing is going to bounce. It's going to correct. And he just kept saying it all the way down. And unfortunately, his followers were, I would see their comments, oh, if he says it, I'm buying the dip too. And what did we fall? I'm going off memory. Wasn't it 500 or 600 points? And it just kept going. And we would have structure, right? We'd have structure on the way down. But he just kept saying it over and over again. We're oversold. We're oversold. I'm buying the dip. Well, we stayed oversold for a long time. Long time. So you can't, I just don't believe that you can use it, the RSI, in its traditional manner. I do like using it this way. And I've been playing around with it for quite a while now. And I really think I've started to kind of figure out how my friend, my friend's the one who recommended it, and he still uses it to this day, but not, again, it's not an indicator saying buy here, sell here. It's an indicator that goes along with the other pieces of your rules and your strategy. It's just another bullet in the gun, right? Another piece of ammunition. But it seems to be very, very reliable. All right, so coming back over here, we won't stay on much longer. As you can see, we're still in this contracting range. Let me just zoom in a little bit. Okay, there we go. We're still in this contracting range. We haven't been able to get through, but we also haven't had a fade yet. That's what you're looking for. If you're going to trade going into the end of the day, and I always warn everybody, I don't like to trade, especially the last 15 minutes, but really the last 15 to 30 minutes. I typically wrap my trading up around 3:15 to 3:30 if I'm still trading at that time. But if you are, you got to be super careful at the end of the day, right? Because things get volatile, they whipsaw, that's manipulated. You just got to be very, very careful. If you're profitable, and there's some people in our room that made some nice trades earlier in the day, just shut it down. Lock them in. Lock them in. Don't give it back. It's one of the hardest things for traders to do from a psychological standpoint. It's so hard to be content. You have a good morning and you think, well, gosh, if I made whatever, 50, 100% this morning, or sometimes you make more, right? You might take a trade and make 400% or something. If I made that this morning, imagine what I could do if I trade all day. And then you trade during the dead zone, which is the middle of the day, and you start giving it back because it's a lot of chop, right? A lot of chop during the middle of the day. Or at the end of the day, you're looking for the big score because you know it's going to get volatile and it goes against you. So anyway, I just believe if you've had a really good morning, just lock it in, go do something else. Start looking for something for the next day. Maybe a buy the close, sell the open trade. I still occasionally do those, but I used to do those a lot in the past. And I've got friends who trade that they're big into that, buying at the close so that they can sell at the open because they think they know what's going to happen overnight. It can be risky, right? It can be very risky. But if you manage your risk, again, and you know what you're doing, you can make some good money. All right, so one last thing before we get off here. We're now into power hour. Again, you see that? It started to dip below, but it didn't fade yet. It's pushing back up. So nothing really to do. If you start to see a strong break one way or the other, and what I mean by strong, I see where I have my alert set. If this alert would go off, then I start to get more interested. Right here, see this alert? If that starts to go off, I get more interested. Because I know my target's going to be somewhere either to here or to here, and that's going to give me plenty. Man, that would be a great move, actually, right? Let's just say, I'm making it up, but let's just say I entered around 31.18, and even this was my first target, 3095, that's 23 points. That's 23 points, and we know that's entirely possible because this was a $50 move from just here to here. So just keep those kind of things in mind. Don't be greedy. Don't overtrade. Don't get overzealous. Wait. Be patient and take the high probability trades. If you can learn to do that and then be content with taking your profit and walking away, you just don't understand how quickly you can grow your account. I'm telling you. So anyway, I'm going to go ahead and let you guys go. We've been on here for about an hour. Thank you so much. Again, give me a thumbs up, subscribe to this channel, share the channel. Everything is free. As of July 1st in the room, everything. Premium content and all that. But you can go there right now, simpletradinglife.com. Click on the free chat room button and join us. We're closing in on 300 members there. We want to blow that thing up, and we want to help as many people as they can become consistently profitable. So everybody have a great afternoon, and we'll see you in the room.